Hey, what's up my friends? So in this week's video post, I'll be sharing with you what is a normal divergence, right? Teach you how to spot them, how you can actually draw them on your charts. Then also I'll talk about the pitfalls to avoid when you are trading this technical concept, right? There are certain pitfalls that you want to be aware of when you are trading normal divergence. And last but not least, I will share with you two trading tips on how you can actually use divergence and improve your trading results. So all this and more in this week's video post. I'll see you there. Alrighty, so let's dive straight in and understand what is divergence. So first up, you have a bearish divergence, which means that price makes a higher high while your indicator makes a lower high. So there is a divergence between price and your indicator. So there's a divergence between price because it made a higher high, while your indicator makes a lower high. So this is where the divergence came in, and this is how traders come up with the term divergence. Next, you have a bullish divergence when price makes a lower low while your indicator makes a higher low. This is a bullish divergence. And what does bullish and bearish divergence means? A bearish divergence, simply put, that when you see a bearish divergence on your charts, chances are is that you will anticipate lower prices to come. And when you see a bullish divergence on your charts, you would anticipate higher prices to come. So basically, by now you should understand, the purpose of divergence is used to anticipate market turning points. So let's look at some charts to illustrate this better. Example 1. This is the chart of the pound yen. This is the daily chart, and I've plotted in the stochastic indicator over here. These settings are 14.33. So let's look at a bullish divergence on this chart. Over here, we have a lower low. And on the stochastic indicator, you have a higher low. There's a bullish divergence over here because, clearly price and indicator are pointing into two different directions. So what followed afterwards is that we had higher prices over here. Another example, this is the chart of palladium, the daily chart. And again, you see quite a few examples of divergence on this chart. You have a bearish divergence over here because prices made a higher high, whereas the stochastic indicator made a lower high. So prices are pointing up higher, whereas your stochastic indicator is pointing lower. There is a bearish divergence over here. Then we see this slight lower. Over here, we have a lower low. And on the stochastic indicator, you have a higher low. Another divergence on this chart, and in this case, it would be a bullish divergence because we are anticipating higher prices over here. And last but not least, we see this example. We have a lower low, and your stochastic indicator is showing you a higher low. Another bullish divergence, and what happened after which is this rally over here. So basically, to spot divergence on the chart is very easy. What you need to do is just to identify two swing points on your chart, two swing points on the prices, and two swing points on the stochastic indicator. Once you've identified these two swing points, all you need to do is to check whether these swing points are pointing towards the same direction. So clearly in these examples on this chart, they are all pointing in separate direction. For example, over here, prices are pointing higher. Your stochastic indicator is pointing lower. A divergence. Over here, prices pointing lower, and your indicator here is pointing higher. Another divergence. And same for here, lower prices over here, but your indicator is pointing slightly higher. So this is actually how you identify divergence in the markets. But before you get all excited, to try and spot divergence, all around your charts, I want you to be careful about one thing is this. You do not want to trade divergence in isolation, right? Just like any technical trading concepts or tools you come across in your career. You do not want to trade all these technical concepts and tools in isolation, because after all, this is only one tool, right? You want to line up a few factors together before you establish your trade. Another thing to take note is that there is also the possibility of you trading against the trend when you are trading divergence. So let me show you what I mean by that. So look at this example. This is the chart of crude oil. This is the 4-hour chart, and clearly over here, you know that the trend is down. you see a series of lower highs and lower lows. The trend is very obvious. It is towards the downside. But on this chart, you also notice that there is a bullish divergence. You see a lower low over here, and on the stochastic indicator, you have a higher low. There's a bullish divergence over here. But you may not want to take this trade because you are trading against the trend, and there's a good chance that you'll probably be stopped out of this trade, which is what probably happened in this example over here. So this is something for you to take note of, right? When you are trading divergence, you want to be sure that you're not being a counter trend trader. It's not wrong to be a counter trend trader, but if you're a counter trend trader trading this divergence setup, you want to be quick with taking your profits. Another example to share with you, this is the chart of the pound Aussie, the 4-hour chart, and here you have a bearish divergence because price made a higher high and your stochastic indicator made a lower high. There is a bearish divergence, and if you're a counter trend trader in this setup, you may exit with small profits over here. And in this second instant, the market may not be too kind to you because, alright, you have a higher high over here and your indicator is showing you a lower high. So chances are you'll probably be stopped out of this trade as the market rallies higher. So one thing to note is that this market is currently in an uptrend. So you want to pay attention when you're trading such divergence setup as well, because like I've mentioned earlier, there will be instances when you are trading divergence and you are against the trend. So now you may be wondering, hey Rainer, so what can I do about it, right? I want to use this concept of divergence. So how can I use this and increase the odds of my trades working out? Here's what you can do. Number one is to trade with the trend, because the trend is your friend. When you are trading with the trend, you are trading along the path of least resistance. So number one, the first thing you can do is to trade with the trend or the longer term trend. Number two, what you can do is to wait for price to show rejection, right? These two factors added up together will help you increase the odds of your divergence working out as well. So let me show you an example. In this chart, this is the chart of the pound yen. This is the 4-hour chart. And clearly you can agree with me, the trend is up. It's an uptrend. So over here, we have our first bullish divergence setup. We have a lower low. And on the stochastic indicator, we have a higher low, a bullish divergence. So now, number one, what we have is the trend is in our favor. Number two, do we have price rejection? So clearly, you can see price rejection over here as price formed this bullish engulfing pattern. So you have the trend and you have price rejection. So this would signal a higher probability setup compared to someone just trading divergence in isolation. Let's look at another example. Over here, you have a lower low. And on the stochastic indicator, you have a higher low. This is a bullish divergence. And again, you're trading along with the trend because you're looking for long opportunities. And do you have rejection? Do you have price rejection showing you, that he wants to go higher? Yes, you have it over here on this bullish candle over here. So yep, you have rejection as well. And in this case, right, price then rallied higher in your favor as well. So, but do take note is that this trading concept is not foolproof, right? You may have multitude of confluence or factors lining up together, but the trade can still be a loser because this is trading. Nothing is 100%. What you want to do as a trader is to take trades when the odds are clearly in your favor, and then just let the market decide whether it wants to reward you or is going to stop you out for a loss. So what I've shared with you is how you can actually use divergence as a concept in your trading. So let's do a recap. So in this video post, I talked to you and share with you what is a normal divergence. Normal divergence can be bring into two categories. We have a bullish divergence or a bearish divergence. Then I share with you the pitfalls in trading divergence in isolation because there is the possibility of you trading against the trend. And last but not least, I share with you 2 tips on how you can actually increase the odds of having divergence to work out for you. So yep, that's all I have for you in this video post. If you have any comments or questions, feel free to leave it below. With that, I wish you good luck and good trading. I'll talk to you soon.